With with rising inflation and fear of recession on the horizon, many are asking, is the real estate bubble about to pop? It's a sensible question considering the run-up in real estate prices since the pandemic has ended. Is another 2008 housing crisis on the horizon, or will the Federal Reserve be able to thread a needle to create a soft landing for the housing market by just removing the speculator froth that has come from things like Ibuyers, build to rent, and Wall Street speculators? We'll discuss all this in today's Quiver Financial News. I'm Colby McFadden, and I'm joined with Justin Singletary and Patrick Moorhead. Gentlemen, welcome. Happy end of July of 2022. It's already middle of summer. Kids are going back to school.
Yes.
How are you, gentlemen? You guys well?
Doing well.
Yeah. Good.
Can't afford a house.
Can't afford a house. Well, we're going to talk about that. We're going to find out if you will be able to afford a house sometime in the near future. So let's kind of frame the conversation, because this is a big question we've been getting from a lot of people, and I've been getting a ton of this in my feed, like on my phone and news feeds. It's definitely a hot topic, and it makes sense because most humans, most of us, like, we're going to refer back to our most familiar time frame. And so everybody looks back to 2008. And even though that was 12, 13 years ago, it's still fresh. You know, people experienced it. So it's kind of natural that when you start to hear about a recession in the horizon, rise in interest rates and things like this, that the natural question would be, oh, will it be like '08? Is the market going to crash? And we've talked for years, and we've been very mute the last 6 months on the subject of real estate trends, because it's been a boring subject matter. Because when, as we've talked about, gentlemen, before, is that if people are at full employment and interest rates are low, which even with the recent rise in interest rates, historically, they're still very, very low compared to, you know, what we've seen historically over the long haul. So if you have, you know, low unemployment and low interest rates, there's really no reason to expect housing to crash, because if people are employed and they're working and they can afford a house, they're going to buy a house, right? And so affordability becomes that real big factor. So we haven't had to talk about this, and now there's been some changes in that, and you know, we've seen a change. I mean, we've seen a change in interest rates. How significant has the change been in interest rates this year?
Well, even going back, you talked about how we haven't been talking about real estate because it's been boring, because it's been just one direction. You know, it's been to the upside. And now with the change that we're seeing, this is the most volatility that we've seen in the real estate market, the single family real estate market, in history. You know, it's normally just kind of peters along, and the 2008 crash is kind of the exception, but the moves that we see to the upside, and now the potential moves that we're seeing on the downside, are making it a little more interesting as time goes on. But I don't think the interest rate story is as big as some of the other factors that we're going to talk about, you know, in my opinion, of having the effect on real estate.
Well, yeah, I mean, so okay, so you've got like a three-legged stool, right? You've got interest rates, you've got employment, and then you've got affordability. And that, if those are the three fundamental things that support housing, there, like you said, it's been a one-way trajectory the last few years, because interest rates have been going lower and lower and lower. Employment's been solid even throughout the pandemic, because there was government money that came in, and so affordability was there. But it seems that you know, there's been a change, right? Because now when interest rates rise, you start to put a little bit of a crack in that foundation. We're seeing inflation. You know, we're seeing now the fear of recession, and possibly will people lose jobs coming up. So now there's another potential crack in that foundation of fundamentals of real estate. And then one thing that, you know, wasn't in the factor of 2008 that nobody, you know, now they're starting to talk a little bit more about it, is these, you know, the world of Wall Street being in real estate in certain markets like Arizona and Austin, Texas, and Idaho, and even Utah, and different places, Michigan. You've had where people have gone and raised money from Wall Street, public companies, and they've bought up big swaths of land and housing. And you also have build to rent, and you have people who've gone into the VRBO and Airbnb game. So in this particular cycle, it's like we have more things to look at as far as, is the market going to crash or not? So we have a couple of stress fractures around interest rates and possibly around employment. But what happens to Wall Street money when prices aren't rising? Because, usually Wall Street money doesn't stick around very long if they're not going to make money. They go look for the next play. So, how do those guys affect the overall situation? So that's where I wonder about, when I get these questions from clients, that's what I'm wondering about is like, okay, what can people do next based on these things, and what should they look for?
I mean, I would just bring in or add to this is like, I mean, you did say that Wall Street, they're going out and buying land and retail homes and stuff. I don't think they're ever going to sell. I mean, as much as Wall Street plays the game that we all play in our, regular day life or what we do every day, but I mean, this is a buy and hold strategy for them. I don't think they're going to sell. I mean, why would they?
Wall Street,
Especially if they're able to get interest rates, I mean, they were able to lock in some of these things that,
I disagree.
Below 4%, below 3% in some cases.
Oh, because I think because the way that corporate governance works, I think that when you start taking stock money, when you start taking money that you raise in the stock market and you put it in assets, whether it's Bitcoin or real estate or whatever it may be, as long as those assets are appreciating in value, you're deemed as doing a good fiduciary responsibility, right? But the moment that those, they're going to lever that portfolio up with bonds and things like that. So the moment that portfolio starts to work against them and it starts to put them in risk of certain covenants, then the CFO is going to turn to the CEO and say, hey, dude, we're now in a totally different realm of fiduciary responsibility to our shareholders. In order to protect our shareholders, we actually got to sell and create cash and get forced into selling at the bottom. So that can totally happen in Wall Street. That's happened many times in all kinds of assets. So that's where my question is, with the Wall Street money, is how do capital markets affect, that factor? Because if Wall Street is only 10% of the overall, or 5%, or a small percentage of the overall market, then it's probably a moot point. But in certain markets like Austin or Arizona or Idaho or somewhere like that, they may be a much bigger portion. They might be 30%, 40%. So it starts to feel like real estate starts to become very regional. Like certain areas could be very stable in the future, and then other areas just get 20% price declines because they had other factors beyond employment and interest rates.
The thing I would argue is, and I agree with you in the fact that, Wall Street's going to cut bait and run if things get dire, because this is a new sector for them. They've invested in multifamily, they invested in industrial, they invested in retail and stuff like that. But single family, Wall Street's not familiar with. So they're making stupid moves, and buying. I shared an article with you guys the other day about Invitation Homes buying right now the most they've ever bought in July. Well, right now is probably the peak of single family real estate. So Wall Street is not versed into how to operate real estate. But on the flip side of things, they're buying single family homes for the rental aspect. So they're trying to tailor it around multifamily. So I feel like they can maybe hedge their bet a little bit and lose some value if they're going to hold it for the long term, as long as rental rates keep increasing. If they keep getting rents and all that type of stuff, and one other factor that we were going to bring in is, you talked about Wall Street being even a new entrance. Well, if the government comes in with their forbearances again, or their no eviction moratorium, that's going to play a double-edged sword of, okay, now they're not getting rents, they might dump the property. But if we have rents, and even during 2008, rents were still increasing during that time period. So that's kind of stabilizes that asset class a little bit more for Wall Street, that even if they buy at the peak, they can maybe ride it out a little more by getting that rental income coming in the door.
Yeah, you bring up a good point. Like, as long as they can service the debt, right? If they have rent coming in and they can service the debt on the portfolio, then, no
Still
worries
a
about
return, a
covenants.
positive return.
Yeah, there's still a good return. So if, they can, especially in a REIT setup or something like that. So yeah, I definitely think there's stability there. That's why it's hard for me to believe that, like, right now it's been really, really difficult for me to say to people, oh man, real estate's going to crash, because even though there's some fractures in the whole structure of things, I don't think they've hit a tipping point yet to create a crash scenario. Now, can that happen? Yeah. So is it still a possibility? Yeah, it's still a possibility. But the thing about investing is narrowing possibilities down to probabilities, right? And the reality is under fundamentals, it's in affordability. You would then say to yourself, okay, if I had to figure out what to do next, then maybe it does look like real estate becomes very regional. And if you're a real estate player, you start to really focus on certain areas that maybe really overextended themselves, or maybe where the affordability came to too much of a stretch. Because I think affordability is a huge, huge factor in this, because with interest rates rising 2%, we've seen a change, in affordability. People have less money, because their payments changed.
Well, and interest rates and affordability kind of go hand in hand.
Yeah.
But one thing that we're kind of lumping in, single family homes is really what we're focusing on right now, and what the news media is focusing on.
Yeah.
But that's one small sector of the whole real estate market.
Correct.
So is real estate going to crash? All of real estate? No. Will sectors have little blips and stuff like that? Single family homes more so than others? Yeah,
Sure.
and that's what people, I think, need to differentiate into your topic about where to go from here. There's other real estate sectors that are
Yeah.
booming right now and still going to boom, in the coming years. Industrial is one aspect of it. I mean, industrial is just blowing up. Data centers is blowing
Yeah.
up. So the
There again,
single family homes is
That's
one place.
commercial.
Yeah. Well, there again, it's. I think as an investor, you go where you can find the affordability factor.
Right.
Where's your best relative return, whether it's in single family or multifamily or commercial or whatever it may be. You have to approach real estate. If you're going to invest in real estate, you have to realize you can be micro focused on only just residential, which is what most people are focused on, or you can broaden your spoke and in your viewpoint and realize, oh yeah, there's all kinds of things. There's light industrial, there's land banking, there's financing of just loans. There's all kinds of other ways to do real estate as well.
And-
Yeah.
Yeah, I mean, to kind of continue on about the affordability factor, I mean, if you were able to get a home, 2 years ago under 3% your mortgage, I mean, now
Yeah.
you're looking at the same home that's $100,000, maybe $200,000 more, depending on the area, like we mentioned.
Sure.
And now you're looking at a mortgage rate or an interest rate of, north of 5%.
Sure. Yeah. I mean, I look at, I've been looking at houses in certain areas, and let's say 2 years ago, they were 600,000 and now they're 800,000. And when you calculate after doing the down payment and everything, the difference in affording that house is now over $1,000, $1,100 a month more. Because essentially what's happening, when you have a 2% interest rate increase for every $100,000 that you're borrowing, you're going to pay an extra $100. So if you're buying a $500,000 house, if you bought it in January, your monthly payment is probably about $500 less than if you were to buy it today. And that's just with the interest rate change, not tacking on if there's been a price appreciation on top of it. So affordability has definitely gotten stretched. So I do think that's why you get froth that comes out of the market. I think you see a slow season for real estate. You see price drops, you start to see some of that stuff, but does it equate to a huge percentage? Like the run up in real estate the last 2 years is like 20+ %. So do you erase all of that, or do you just, pull back 4, 5, 6, 7% of it? That's because like when people say, okay, well, what do I do next? Right. Okay, great. Hey guys, great. Maybe real estate does or doesn't crash, but regardless, I got to figure out what my next move is. And so, what should I do? And so it's like, I always look at these things and say, okay, well, then segregate your money. If you're dealing with liquid money that you have that you can put into stocks and bonds and things like that, okay, then you start looking at the capital markets and you start looking at home builders. And if you have a belief that real estate's going to crash, you start looking for ways to possibly short against those home builders. If you think real estate's going to keep going and home builders are going to go longer, you can go long. I mean, what I would do is I'd climb up the capital stack. I would think that that all this news over the next couple months is probably going to push the home builder prices in the capital markets and the public markets lower. Usually that's going to push their corporate bonds lower as well. So I would start to look in that space and say, hey, can I find some good quality corporate bonds that start trading at a discount of a home builder that I'm pretty confident isn't going to go through bankruptcy if things get ugly? Because then at least you're going up the capital stack and going into the bond world from the equity world, you're getting paid to wait. And if you can get them at a discount, you might get some growth out of it if you can handle that kind of risk. So I think from a capital markets, that's one way to do it. I think most people, though, like Justin, for you, like you're a young guy trying, looking to get married. Your big question is what? Should I buy a house or not?
Yeah, no, right now, I want to just touch on a thing that you brought up a second ago on the home builders. So as of the end of June of this year, home builders they've had cancellations for, a lot of their building projects. It's up over 14% as a national average.
Yeah.
The largest home builder, what is it, Dr. Horton, I think. Mm-hmm. They saw a 24% drop in the contracts that they had already had going in the month of June. So we're already seeing some of that, when you talk about home builders. And yeah, I mean, for somebody like me, especially in an area like Southern Orange County, New York in certain spots, Florida, Austin, Texas now, it's becoming, so rich that, it's not affordable. And I think one thing that we maybe can touch on, not super well, it is important, but, is people's earnings. Are they making enough, with all of this change and with the way inflation is, do they make enough to even ever get a chance to put away money, or do they need to go job search again and look for something where they can get a higher wage to start saving money? So I think that's a big area too, is the wage gap. I mean, yeah, sure, if housing prices come down, that's great, but if people still aren't making enough money, then we still have a problem.
Yeah, well, that's a whole nother show, because the thing with that is like, you realize, hey, you know what? My parents are California kids. They went to Wilson High School, Long Beach, right? That's where they met. My brother was born in Pennsylvania. I was born in Louisville, Kentucky. How do two California kids go have kids like, across the nation? Well, you know what? It was the late 60s, early 70s. You know what was happening? Exactly what's happening now. Inflation. What did my father have to do? He had to make money. What did he do? He moved. Right. Yeah. So people are going to move. They're going to go find jobs. Yeah, there's going to be more circulation of things. So, what can people do? That's why real estate becomes really regional, because then the areas that are supplying the jobs are probably going to have the advantage. So like you talk about the cancellations, is I listened to a podcast just the other day that said in certain areas, like some of these areas that got really, really hot, cancellations are up to 30%. Makes total sense, right? So that takes the froth out. So, what does a young guy like you do? Like, what people want to know is, hey, if I'm trying to buy a house, like if that's my goal is to buy a house, should I do it now or should I wait? And like, I've been looking at houses, and the only equation that I can come up with is I'm like, okay, I don't want to buy something in front of a, potential train wreck. So, all right, I'll go back. I'm just going to pretend like the pandemic never friggin' happened. I'm just going to just say, okay, you know what? I'm going to go look at 2019 prices, whatever this house sold for, whatever I'm going to look at what it was worth 2019. You know what? And I'm going to tack on a respectable 5% growth on that, just like any asset would grow, So from 2019 to now, we've got 4 years? Is that? So, 5 times 4 is 20%. So you know what? I'm going to throw my offer out there 20% above 2019 prices. If you do your math, that's still way below what most asking prices are today. I mean, you're still way below current market. And who knows? In hindsight, you know, you may end up still overpaying. That's why if you buy a house now, if you're a young person or any kind of person buying a house, you better buy it with the idea of, I can own this thing for 10, 15, 20, you know, like you better buy it with the idea that I can ride it out. I like this house. I can either live in it or I'm buying it and it's yielding me enough off of the rent that I can afford to hold it regardless of what price happens. So I think
But-
anybody trying to do it based on rent plus speculation should remove the speculation.
I'm going to argue against your that sound logic, and I like that. In a normal world, that would apply. We have too many variables now that have come into play. You know, the unemployment aspect we haven't really touched on too much, and I just kind of want to briefly talk about that. That all the baby boomers are retiring, so I feel like we're not going to have the spike in unemployment like we typically would in a recession, because we're losing more workforce people than we are gaining with the millennial, the Gen Zs, and who's ever above, you know, the millennials. So our unemployment is kind of always be there. Plus, with the work from home aspect that's going on, people are taking up two jobs because they can slack off on one and slack off on another. You know, why not get paid from two? It also goes against your regional aspect of things, to where people can work from anywhere now. You know, that I see more advertisements of great places to work from home, you know, that are now outside of the US or in tropical locations, or, you know, things like that. So it changes the whole demographic that we're used to in real estate. So the frothiness that we talk about, I do feel is going to come down, but we have been in such a supply lack for 15 years that when that price does come down a little bit and people start to see a drop and you know, some restrictions start coming off, there's going to be more buyers that come in and be like, okay, I can maybe afford that price now, even with interest rates high, because and interest rates might come down and I can refinance in 5,
Sure.
10 years.
Sure.
So I don't think this is going to take time, I feel like, to maybe work itself out. And I don't think we're going to have a big enough pullback to where it's going to bring it to your standpoint of the 5% a year. It would be great if we did, because we're all looking to buy more things, but I just don't think that's going to happen.
Yeah, I think my system only works if you're probably seated across a motivated seller.
Yeah.
Like my system would work if you have somebody who's like got a viewpoint, because realize on the seller side, there's some people, there's different psychology, right? You got to realize who you're seating across from it, and you don't always get the luxury of knowing that until you get into the negotiation process. But you know,
Yep.
somebody who bought it and needs the money for another project or whatever, needs the cash, may be more motivated, as opposed to somebody who's just like, I know it's worth more, and I'm gonna dig in my heels, and I'll sit here for 6 months until I get my price.
Well, and that's where the home builders and the home flippers, you know, are going to be a better buy potentially, because they're more motivated to flip the stuff faster. When you have majority of the people selling, they're selling because they have to, because they're either moving for a job, they're retiring, they're doing whatever. So, but they usually have time to work that out. They're not in as big of a rush. And some of the froth that we're seeing is maybe people who are, you know, want to take advantage of the big market that we've gotten, and they're overinflating, you know, their prices. Like I could flip my house for almost $300,000 more than what I paid for it. But the odds of me getting that price, even though that's what Zillow and all them are saying, probably not, because the market still has checks and balances of, you're not going to have a house in a neighborhood that is way above any other house that's, you know, kind of on the market. So that's where a lot of these people are seeing what Zillow is saying might be their price, and they're, you know, thinking that they can get that. And then, you know, the real estate agents trying to adjust their thinking with, no, we're probably not going to get that price. Here's a more realistic price. Well, they're not going to want to drop the price when they're, you know, realized 2 months ago that they could have maybe gotten that price. So that's what I'm saying. It's going to take a little bit to work this out.
Yeah, well, that's why it goes in cycles, right? And that's, if you're in the market to buy, you just now have to be on your toes, because now the cycles start to shorten, and you got to really pay attention to your region. I really think, you know, more importantly, it becomes very, very regional, because there'll be certain areas that, will probably hold together, and there again, it depends on those other factors of employment and how further interest rates end up going. I'm imagining that rates are probably about where their main level is. And because otherwise, then what's going to happen is wages are going to have to increase. And so, the inflation is never successful unless you can push housing prices and rent prices higher. So this is back to what you were mentioning, Justin, is that when the Federal Reserve, when the government realizes there's too much excess and they need to slow it down via inflate, like they rising rates and things like that, what they've got to do is they've got to push the affordability to a point where it slows the speculation and takes all that froth out of there. So that's exactly what, and then the Fed's just trying to figure out where that level is, right? And we're probably right at that line. So I think, rates are probably, I don't have high expectations that they keep going, multitudes higher from here. If anything, I would think maybe they take a little pause here. And I'm not just talking the Federal Reserve doing what they're doing. I'm just saying the market itself, the 10-year rate and such. So, I think if rates can cool here and employment holds together, and Wall Street doesn't totally fall apart, I think you're right, Patrick. I think things, stay stable, and you don't have to chase things, but you do have to stay on your toes. Let's wrap it up with one question. I mean, what would you do? Let's say this, guys. Let's say you're older. Let's say you're in your 70s. You own multiple houses, and health is changing, whatever it may be. What does somebody like that do? Like somebody who's in that kind of scenario, do they keep all their properties, pass it down to the next generation? Do they sell some properties and monetize some of it? Do they exchange them into something else? I mean, it's probably very personal.
Yeah, that's a tough one because it's very specific to what the goals are of the investor. But there's many options that they can really do with it, and if you're not at the stage where you need the money that's in there, I would say sit on it. But if there's are options to where you can avoid taxes and take the money and sell at the peak and maybe buy later on if you have the time to sit around and wait for the real estate market to come back down. So it's very specific to what the investor's needs are.
Yeah, I mean, I would just add, kind of like Patrick said, very specific, but I mean, those that own multiple properties, you're looking at potentially what generational wealth, depending on if they want to keep that in the family, probably something worthwhile, but why not take some off the table? Now there is the problem of a taxable gain. You got options there and what you can do, but I mean, let's say you got 5 properties, why not sell 2 that are maybe in a pretty high price market? And who knows, maybe in 6 months, 18 months, it could be a little bit lower and you could actually get back into something in the same neighborhood, and have a little bit of equity at some point in the future because you waited it out a little bit longer and sold a little bit at the higher end of the cycle.
Yeah. I'm working with a guy right now. He's got 6 properties, and he's in his late 70s, and he's going through that same dilemma, and he's kind of like deciding a little bit of both of what you guys are saying. Is he said, okay, you know what, I'm going to look at my properties that are the biggest pain in my side, right? The ones that are older, that need maintenance, that yield me the least, and I'm getting rid of those, and I'm going to monetize those. 1 or 2 he decided to pay some taxes on just so he had the cash. The other he's deciding to exchange it to something that he doesn't have to manage afterwards through like a DST. And then he's going to hold on to the best properties that yield him the best and have the lowest amount of maintenance, and make a decision on those later when he gets more answers on his health, because he's having a health change. So I think those are the sensible things, and that's what's neat about all these things, is you don't have to do all or nothing moves. A lot of times when you're looking at your situation, whether it's stocks, bonds, real estate, whatever it may be, you can do things in stages and you can do things in increments. And that helps reduce a lot of the anxiety around these decisions. And then questions like, is real estate going to crash, doesn't really come into your decision making. You're making decisions based on longer term, playing a longer ball. If you're a speculator, right? You know, if you're a speculator and you're trying to maximize every opportunity, every penny, okay, yeah, then, you know, be that way. But if you're really like everyday average Joe, I wouldn't really worry too much about the real estate crash or not, or this or that. I'd be just keeping my options open. And like I said, if I had capital money, I'd be playing up the capital stack of corporate bonds. I'd be looking for opportunities there. If I owned multiple properties, I'd be looking for a way to monetize them and reduce my headaches. And if I was a young person trying to buy a house, I would be patient. I would be patient. I wouldn't expect, prices to come into my desired range like where they were 3 years ago. But I definitely wouldn't be, offering people over market value.
And
I agree,
anticipating
100%.
Anticipating that rates are eventually going to come down. I feel it's better, buy the price, that you can maybe afford now and refi later, because we believe that rates are going to come down.
Well, yeah, and when recession comes in, if it comes in, rates snap back pretty damn fast. You'd be surprised.
I was going to say that historically, if you pull up the 30-year fixed rate mortgages over the last 50, 60 years, every time there was a recession, within post-recession, rates started to go down. Every time.
Yeah, there's never been a recession where you didn't see a spike up in energy prices, a spike up in commodities, and a spike up in interest rates right before it. That's what a recession is. Things can't go like that, right? They have to recede back and then come, so this, it's, the news acts like this stuff is all new, but this has been going on for hundreds of years. So
the biggest thing to remind people is, during the 2008 crash, I mean, did people really notice that the value of their homes really, dropped 20, 30%? If you're living there, paying your mortgage, you don't care what the price does for the most part. So, I mean, for the people that are holding their properties and not needing to do anything or expecting to do anything in the next 5 years, you don't care. Like, let it fluctuate.
Yeah, that's why you don't want to be over leveraged. I think Warren Buffett said it best. A lot of smart men have gone down with leverage, liquor, and ladies. So leverage right now is dangerous in that space. So
glad I only have to worry about the last two. The first one.
Yeah. All right. Well, let's wrap it up.